like to welcome everyone to the August 27th meeting of the CERS Investment Committee. This is a regular meeting, and we have a relatively full agenda, so I think we'll get started in a very prompt fashion. So I'd like to call the meeting to order. And Eric, would you please read the opening statement?
Of course. This is a regular meeting of the County Employees Retirement System Board of Trustees Investment Committee. This meeting is being broadcast via video teleconference pursuant to KLS 61826 and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road in Frankfort, Kentucky. It is also being broadcast to the public live via Facebook. If you are speaking and not appearing by video, please identify yourself before talking. If the video or audio is interrupted, we will attempt to reestablish a connection. Connection cannot be reestablished within 30 minutes. The meeting will be adjourned and rescheduled to a later date.
Thank you. Sherry, would you please take the roll call?
Yes. Dr. Hackbart?
Here.
Mr. Cheatham?
Here.
Mr. O'Mara?
Here.
Mr. McGraw? Mr. Filkison?
Oh, here.
Thank you.
Good, thank you. Sherry, I don't believe we have any public comment. Is that correct?
We do not have any public comments. That's correct.
Good, thank you. First item of business is the approval of minutes for the CERS Investment Committee meeting of May 28th. Would someone please move the approval of the minutes?
Move approval.
Is there a second?
Second.
Any comments or discussion of the minutes? If not, we can proceed to vote. All in favor of approving the minutes of the May 28th meeting, please indicate by saying aye.
Aye.
Motion passes. Minutes have been approved. I would like to make an adjustment in our agenda, if I might. I've got to depart from the meeting briefly at 3 o'clock. I'm not sure how much. We have a relatively full agenda, and I'd like to make sure we take care of these two action items, if that's okay with you, Steve, and Ed. Is that okay with you? Would you be prepared to move up in the agenda?
Sure.
Sure.
Okay, thank you. So, Steve, would you take over the meeting and talk to us about the private equity investment recommendation that you're bringing forth to the CERS Investment Committee, please?
Sure, Sandy, if we go to page 133, there we go. As we've discussed on multiple occasions, there was a period when the pension portfolios were not actively investing in private equity asset class due to liquidity concerns. The portfolios have maintained a structural underweight to private equity, really as we viewed it as having limited value from a relative risk reward standpoint, with better opportunities available in other asset classes. We've continued to evaluate potential investment opportunities in the asset class, and Anthony is going to provide an overview and update on both the current private equity program as well as presents what we feel is a very compelling opportunity in a new fund being offered by an investment manager who has been managing money for the systems for almost 10 years. So I'll turn it over to Anthony to provide kind of an overview of where we are currently in private equity as well as this new investment opportunity.
So thanks, Steve. Yes, can we go to the next page, please? Okay, so that's the page that Steve was talking about. In terms of there's been a structural underweight, which you can see on the right side there. The target was also reduced because of the better risk returns seen elsewhere, also in the asset allocation that you guys did in 2024. And so the next slide after that. Speaking to that, you can see since interest rates, went up from 0 in 2022, the risk return for private equity has decreased in attractiveness. So just looking at even the Wilshire numbers they have from 2020 to 2025, you can see how the expected returns have gone down. Obviously, the expected volatility is still quite high, even though it's not always apparent given the marking. But you can see the attractiveness for other areas went up, especially with interest rates up. Obviously, credit went up, and so that also has contributed to the calculation for risk reward not being as attractive for PE. I would say valuation's always been an issue since I joined, which has been 9 years now. It's hard to believe. And then at the time, you also saw larger and faster fundraisers. It's hard to believe that now, given we've had the exact opposite environment where fundraising has slowed significantly, mostly because peers and other investors are too full of PE and aren't getting any money back. So that's something that we are always a little cautious about. People were just deploying money very quickly and coming back quickly. You obviously have to want to see if they're funding. It's a difference if they're funding something attractive to you versus just kind of deploying it because that's the incentives involved in this game. So anyway, so we haven't proposed any commitments actually in a while, and one of the last ones was the previous fund that Strategic Value Partners did back in 2021. And so you can go to the next page, please. So here you can see our allocation. P is there on the left in orange. That's a little bit underweight as we discussed. When you break out that orange slice on the right, you can see what makes it up. We have quite a few line items, over 50 in all, but there are several de minimis ones. Really about the top 15 make up 3/4 of the exposure here. And some of that is still legacy Bay Hills, which was obviously a very outsized exposure in the private equity portfolio in the past. So it's still a pretty big chunk here. So you can see. We can go to the next page here. And here, among that, mostly is buyout, your normal private equity that you think of. That's about 70%. 20% is more in the distressed area. Some of that Strategic Value Partners, which we're proposing today. There's some legacy venture stuff in the gray on the left. Some of that stuff just lingers and lingers, unfortunately. And then that speaks to the part on the right where almost half of it is 10+ years old vintage wise here. So I think we've discussed that previously in terms of legacy private equity. There isn't a lot you can do about those. I mean, you can obviously do a secondary sale, but it often isn't economic because there isn't a lot of demand for the tail end assets. And also it's quite a lot of resources to run a process and work with the different managers to get those sold because there's a lot of approvals or legal things that have to happen because they're all individual legal contracts. And then for relatively small amounts of money, like I think we discussed last time, it was the 100 million or so of legacy is basis points in your total portfolio. All right, the next page. One you might have seen before, unlike other areas that you're probably maybe used to, public or public securities, this is not something that you just do a search for at one point in time and say, hey, let me see, I just want to find a bunch of them and then pick one. There's various strategies raising at different times, and the fundraisers can be elongated like they are now, or they can be one and done closes. So it's something that you have to monitor all the time. We of course get many inbound proposals and also find ideas from all over the news, peers, consultants. So it's something that is ongoing, as you can see in the first bullet point. And so same for due diligence, like we get stuff in, you kind of check it out. There's many managers that I've been getting emails from. I mean, I've been here long enough that I've seen 3 or 4 IR people per fund. Those people turn over all the time. We're still here, and you can see and you get the decks, and you see what's changed, what they've done, compare that to things they might have told you if we had bothered to take a meeting with them. So it's an ongoing process. It's not just something you do at any point in time. So, and of course, like I said, the third bullet, you can everyone has their own different strategies. So there's usually some peers that you can at least compare them to. Of course, obviously, tend to look for people who are trying to do something a little different. So ideally, there aren't a lot of competitors. I think you've heard that it's expressed by us a lot, and especially in real returns, because there's some of those areas are relatively niche, and it probably doesn't make sense to have very many players in that area, or just they figured out something that has advantaged them versus others. So in private equity, that's less so, because it's kind of a lot of people do the same thing, and you probably heard and seen how private equity firms buy and sell companies to each other. So sometimes it can be some of those things can look a little bit more the same, but occasionally you find some people who are doing strategies that are a little bit different. and this is one of them that we'll talk about shortly. Let me go to the next page. So these are some of the issues we've seen in some of the various areas that underlie private equity. As we discussed, buyouts is obviously one of the larger areas. It's around 70% of our exposure here in FTSE. It's what you've probably heard of. Firms will buy companies and usually some leverage. The company's cash flows are the thing that do lever the debt, which of course creates equity value for them. Ideally, and then if the multiples expand or EBITDA expands or both, then lots of money for the PE sponsor when they sell, ideally. So that's a strategy. Of course, getting in on it has been more and more expensive. You can see from the bottom left, multiples have greatly expanded from post-crisis when it was in the high single digits to averaging around 11, 12 times. Obviously, you hear many deals that are much higher than that. We had an exit of a retail-focused business, Tropical Smoothie, this year that was at above 20. So it can vary. I mean, this is just an average. So and then leverage creeps up over time. I think usually in the most heady times you see 5 to 7 times leverage is the most you see. There's here an average of 5. When I did direct lending years ago, that's when it was frothy. 5 by 7, and with PIK was usually near the top. So you see that sometimes. Obviously, I think that's less so right now. You can see the sentiments on the right in terms of where we are, and based on Hamilton Lane's views of things, it looks like for leverage and coverage of the debt, some of these things have gotten worse and worse over time. So it's again another reason why we have been more reticent, I guess, to do things here. Can you go to the next page, please? This is about secondaries. Again, we were talking about that as being a seller earlier in terms of like cleaning up some things. In theory, that's good. It just isn't a very deep or liquid market often, especially for some of those funds that are off the run. Another thing that's less attractive, I mean, buying debt at discount is obviously interesting, but it's less attractive when you think about how much capital there is you're also competing with, because there are billions and billions of dollars that are sitting on the sidelines to deploy. And so when you have a lot of brokered processes, which you tend to see in this area, I think Evercore is probably the dominant one. That's usually the firm we see who are doing the continuation vehicles that we get presented with all the time. There's a few other players as well. And so you have a lot of this capital coming to the market and bidding in these things, and discounts get narrower and narrower. And obviously, sometimes people use leverage to make it pencil out, but the discounts get narrower and narrower for some of these assets. And so and also deploying to really large funds is difficult. I mean, I think you can see on the bottom right some of the large funds that have been raised recently in the $20 to $30 billion range. I mean, basically just have to buy everything almost at some point or be a part of it. And you've seen that. And I think Yale and some of the headline deals you might have seen in the news, multiple firms have partnered up or divvied up some of those portfolios that they found attractive. And again, speaking to some of the ones that, I don't know that all the things in those portfolios got bids. I think usually it's and it tends to have portfolios. A few line items drive the value, and then if you're bidding, the rest of it's just option value. You value it at 0 or very little, and if something happens, that's great. But your bids are based on the major assets within there. So there's some things that are issues you can see on the right in terms of why we haven't added more to that either. Can we go to the next page? Finally, it's venture. I mean, that gets a lot of headlines. You hear about it every day with AI and other technologies. The problem is getting in on these it's not easy. There isn't a lot of funding that's necessarily required, especially these days. I mean, there is some with the data and the compute that can be, but for the most part, a lot of companies can be started with not tons of capital, and then getting access to those is difficult. And then, we're not going to be at that layer. So then getting access to the venture capitalists is also difficult because that's constrained. And for the most part, we aren't going to be able to put enough money to work to make it matter for us in terms of the portfolio. So that's the reason why we have not done as much in that area. And with our limits of how much we can be of a fund as well, that also limits how much you can be. A lot of these are not multi-billion-dollar funds there are on the very large end, but I would say that's probably not venture at that point. It's more just growth equity because you can't just put in that much money in these early rounds. So that's why this has mostly been a non-starter for us, I'd say. So let me go to the next page. So one thing we are interested in is strategic value partners. These folks do take control of some of companies in their portfolio, often through the debt, and they build up the stake through them. We have invested with them since 2018 in Fund 4 and Fund 5. This is Fund 6, where they have continued to follow the same strategy. We've seen them deploy in markets that are just kind of going along, like in Fund 4. And then obviously through COVID, where they were able to take control of several companies that need to restructure or had some difficulties, especially involved that were directly affected by COVID, like airlines, as well as malls and other airport services. And so, again, there is competition, of course, for these. You can see through some of these, the ones they are able to take control of. Again, bankruptcy and all that stuff is documented, so you can see who else is in it. There's the who's who's of distress and things like that, but they were able to source enough to gain control in several cases like Swissport and Omnimax and others. And so that's the strategy that they have been able to pursue for 15 plus years now. We've been along since 2018. You also may remember last fall, we presented a continuation vehicle for a toll road in Texas. That's something that they purchased in 2017 through bankruptcy and grew and exited to the continuation vehicle. We were able to continue our small portion that was in Fund 4 and then add to it because of the ongoing recurring revenue and the potential growth that the asset has. And so that's something that we find attractive. And so you can see on this page in the blue what kind of exposure the KPP as a whole and what C has put in, and how that and what value is still left there. It's about 1% of the total portfolio, and then we're proposing adding another 50 basis points here. So go to the next page. This is more on the process, like I was just talking about. They buy into many deals. And over time, as things go on, if they can, depending on what paper they're able to source, what deals they like, they're able to take control of several deals and make those the key assets in each portfolio. So how that's done is in the bottom part of that page. The next page here. And the terms, these are the usual terms. Those are the rack rate ones. We would, if we commit to this, we would likely have discounted terms near the bottom that possible, given our size and Wilshire's aggregated discount. And so, but that's again part of the legal negotiation should we get approval for that. So, and go to the next page. You guys have probably already seen, but this is just an overall slide of SVP, what they do in terms of opportunistic credit and taking control of companies. Go to the next page. And this is sourcing. So what I was talking about, there are banks, especially in Europe, they've historically about half and half US and half Europe. There's a lot of bank financing over there, and when things get stressed, they are not the logical holders of this debt, but they aren't exactly dying to sell it discounts or make large blocks or headlines with that. So having direct sourcing relationships that SVP does can help the banks and also help themselves, of course, buying at attractive prices. You can see at the bottom how in Fund 3 and Fund 4 they build these investments like just piece by piece. So they're calling on different folks and sourcing debt. And it takes a lot of time and transactions, so not easy to do. And I think that is something that sets them apart. Next page, please. So here, this is their approach. Or sorry, can you get a page before? Or yeah, that's the right page, I think. Let's see here. Can you go one back, please? That's 4. Okay, 1 4 from the sourcing one. That's there you go, vision. Okay. So there are a lot of folks who play in distressed debt. I mean, this stuff, a lot of these papers on Bloomberg, and it does trade here and there. But in terms of actual being able to operate and influence the company rather than just be traders. There aren't very many of those anymore. It's something that you have to have the right vehicles for. A lot of credit hedge funds that are in the space are not a drawdown structure. They're more of like the regular hedge fund structure with monthly or quarterly liquidity. And that's not going to work for some of these things that are longer term fixes. And so there's really only a handful of companies that really do this. And some of the ones that would compete with SVP are much, much larger now. And so they are not going to probably compete in some of the companies that they do because it's just not going to move the needle for them. So there's a few, but it's the supply of competition has gone down over the years, whereas they believe the supply of debt um, is increasing. Their deployment has been was significant at the end of last year, and has picked up again just in the past 2 months. I think you might have seen there's an article, I think last week, about JP Morgan talking about the defaults in private credit reaching 4 to 5% already. And that's just the hard defaults, not the ones with the extend and pretend or liability management exercises. So it's something that they have been seeing. I mean, obviously it'd be nice, having a distressed environment is good. They've been able to deploy without that, but they also see a significant opportunity coming. So go to the next page. And this is over time how they invest and they harvest and get the money back to folks. So it obviously takes a few years to get things as they are able to assemble the positions and then operate and change things and return money back to folks. So we've been getting a decent amount of money back already. So for Fund 4, I think we're above 1x now, or back at 1x. We've received our money back and continue to get distributions. And so. All right, next page. Okay, that's it. So happy to take any questions from you guys. But yeah, I think some folks have spoken to them, and also you've seen the materials from the different deals and funds. But yeah, happy to answer any questions you'll have.
Anthony, thank you for a very comprehensive review and information, both in terms of context as well as this particular opportunity. I guess one thing that strikes me is that we look at our performance information that, in if private equity has underperformed public equity by I think a significant degree. Do we think this is going to be changing over time, or I know we're under allocated based upon our asset allocation policy, but is this a good time to move in that direction to make that reallocation, or is this a longer term tendency in terms of underperformance of private equity? We have any perspectives in that regard?
I think prospectively, you're absolutely correct. And as we'll talk about in the investment review, the underperformance broadly of the private equity market recently compared to public equities. Now, the expectations, Wilshire can certainly weigh in given their capital market assumptions. I think that Anthony actually showed for the private equity and the public equity earlier. But the expectation going forward, I think, is that private equity over the long term is expected, given the illiquidity premium, is expected to outperform public equity markets. Obviously, that hasn't been the case. That's one of the reasons we've been structurally short. I think what we look at is, within that broad private equity space, where are the opportunities that have the potential to outperform? So as Anthony mentioned, we're not necessarily going to get, over our skis in venture or in some parts, some strategies within the market, because I think there's still some work to be done there, especially with, rates anticipated to remain elevated and the sensitivity of some of those strategies to funding cost. So we think this is an opportunity. Again, the portfolios are underweight. I think this opportunity brings us closer to target. We'll remain underweight. It's certainly not waving in. We're not looking at adding to some of these mega funds or just waving stuff in haphazardly. I think we're very conscientious in which investments we're think makes sense within this perspective in the overall portfolio context. So, I I don't want to necessarily. I think anyone that's going to tell you crystal ball that private equity is going to outperform over the next 5 years, I would be a short seller of that. But I think longer term, this investment specifically, if not overall private equity, makes sense in the portfolio. Again, I don't think you'll, as Anthony mentioned, I think it's the first recommendation we've made in a number of years. It's not like we're going to see 5 or 6 more recommendations, over the next 12 months. We make recommendations when we think it's this specific investment is a good opportunity for the portfolios.
That's right. Yeah, and when you look at page share, can you turn to page 135? Yeah, you can just see. I mean, again, so private equity returns, you're not getting significant pickup for the illiquidity and the risks that you have compared to other areas. And so, but that's just on the whole. I think this is an interesting opportunity because of the significant amount of material they have to work with, right? In terms of stress companies, um, they've been able to put if they don't. I think the knock on distress is usually that's a trade, not a real opportunity. I think that they would argue, and their record would argue that that's not the case. You're able to find stressed or distressed companies in all environments, and they've shown that through deployment and returns. So, and being able to create entry create ownership of these companies at significant discounts to what previous owners have is also a margin of safety that I think is interesting. It's not your traditional PE firm bidding in all their auctions. That Lincoln or Moelis or whoever runs the process runs and do the bids and see who wins and who can put the most leverage and all that. That's not really what they're doing here. So again, that's why we're not just going for regular way private equity. We're trying to find something that's going to be a little different and has a reason to make more attractive returns than just whatever else is doing.
So if I understand, then basically what this particular opportunity focuses on, again, on distressed properties, but I assume they're also doing background and context reviews of those distressed properties and selecting from those which may have unique reasons and consequences that they may recover from if they're actually acquired. Is that sort of the strategy then?
Yeah, a lot of times I mean, I think that people always say a lot of there are good businesses, bad balance sheets. So one of the examples I think that they discussed when you guys talk to them and that, we unfortunately know well in our own portfolio because another sponsor owned it and is not controlling it anymore is Hornblower. So that's the company that does the ferries for New York City, Statue of Liberty, Alcatraz, Niagara Falls. Obviously COVID was significantly impacted them. And they got significantly over levered. For $100 million EBITDA business, round numbers, they got to about $1 billion of debt. So that's 10x leverage, and that's 10x of what EBITDA was when normal times, right? It was 0 or negative when things were shut down. So obviously that wasn't something that they could sustain, and so they were able to source the paper and the debt to be able to get control of that. Actually, the sponsor who did own it also tried to buy back some of that debt as well. So they're still in a deal. And so I guess we have exposure both ways. But that's something that they were able to do. It's a good business. They were able to, obviously they've recovered, now, but buying in at bankruptcy level valuation versus what the prior owner did is, it makes things a little easier to outperform. So does that
I
make
think
sense?
if you look at their past funds and the funds that we're invested in the prior ones, it's getting good assets. To your point, Dr. Hackbar, it's getting good assets at a very good price, right? And if that thesis or that strategy, again, not having even gone through a credit cycle here and still being able to deploy capital is pretty important. And I think it's a vetted strategy. I think Wilshire is also supportive of the strategy. It's worked well. The team works well. They stick to their knitting. And as Anthony mentioned, this isn't the case of some of what we see in private equity where it's a beauty contest or a bake-off, and there's, especially with the amount of dry powder, there's and the talk of retail investors coming in too, right? That there's going to be competition for these types of assets. That's where we're staying away from for the moment. or at least a little more cautious. And again, this is not quite niche-y, but it's certainly a differentiated strategy within the space.
Thank you. Are there other questions of Steve or Anthony?
I've just got a couple of questions. I noticed, Wilshire, that you got on your investment concerns was departure of recent senior team members. Do we know whether those departures were going to a different firm or just out and out retirements? What kind of impact do you expect that to have?
It's been a mix, Law, I would say. I mean, I think if you go to, let's see what um
I know we've had concerns in the past over key person losses. I just wanted to see what.
sure. If you go to page 142, so the team's grown a lot, right? Obviously assets have as well. But so I think this was back in 2018, it was more of an issue with 39 investment professionals and now have over 100. And turnover's been a thing. That is the number one thing I pay attention to, and I have, are on them about. I shouldn't find out from the press or, my website crawler or stuff like that when some people are leaving. So, yes, and then each fundraise they've lost, ahead of one of the regions. Some of them have been retirement. Like I think there's been a couple in Europe, like a sorcerer. She wanted to spend time with her family. There was a head of Europe who I think still is a math teacher. He's not been in the industry. There's others who have gone to other areas. Actually, Dan Hahn from when he left in round fund 4 ended up at New State, which we are also invested with. So people, they go to different places. Some people are in the industry, some people are not. There's a person from Europe that has also departed last year. I don't know if he's landed yet. There's some non-competes and things that are also involved. There's a person in Europe in 2019, I think, that went to HIG, to Bayside. So he had been involved in some of their Europe deals, but they have, quite a strong bench, I think, behind them. Yes, this was definitely, I mean, the turnover's been a thing. I think that's kind of part of stressed investing. I think we have exposure with several other funds, and that's also a thing. It's not the easiest way to do things. So, but yeah, I think that's something we obviously are very mindful of. But with a significantly larger team, I don't think that's as large of a concern for us right now.
From what I've looked at as far as the investment itself, and that's I guess trying to discuss. I like the fact that it is a value strategy, number one, and that we're looking at a specified term of 8 years with 2 possible extensions. Notwithstanding our issues of what we're benchmarking against as far as our private equity category, which I hope, Steve, we're about ready to make a change and figure that out. I can't help but, based on the material that Anthony put forward early in his presentation, that showed nearly 50% of our exposure in this asset class is 10 plus years old, may not be one of the reasons why it's a drag. Investments that look good today might not look good 10 years from now. So I think we really need to take a close review of where those 10-year plus old investments are, and what kind of exit strategies are in place. But as far as this particular investment, based on their track record, I certainly support it.
Thank you, Lyle. Other comments or questions? If not, is there a motion to approve an investment of up to $100 million in the private equity allocation into the Strategic Value Situation Fund 4, subject to successful negotiations?
I'll certainly make that motion.
Thank you, Lyle. Is there a second?
Second.
Any further discussion or inquiries? If not, we can proceed to vote. All in favor of the motion signify by saying aye.
Aye.
Opposed? Motion carries. Thank you,
Thank you.
Steve and
Thank you.
Anthony, for your very good presentation, discussion. I think it's been very helpful to the committee. We appreciate it.
Thank you.
Next, as I indicated earlier, I'd like to move the other action item up, again, as a personal privilege, and that is the possible investment policy statement amendment that Ed has been working on. As we recall, we've considered our policy statement as sort of a dynamic document. That there are changes which can be made positively, periodically. We would not be hesitant to do so. So, Ed, if you would you discuss with us this proposed amendment to our investment policy statement?
Thank you, Mr. Chair. Sandy, if you would go to page 165 in Board Book, please. This is the only page that we're going to look at to discuss this proposed change. As all of you know who have been on the investment committee, we've spent 5-6 months putting the IPS together with the help of our investment consultant, Wilshire. We did great work to improve the oversight that this committee and the board has over the investments of CERS. We started to get 6 months ago or so a number of inquiries from managers, general partners who wanted to extend their fund. So we wanted to drill down on just this section, tighten it up a little bit, and make sure that we were expressing exactly what we wanted to do here. So in the heading, we're removing continuation vehicle. That has a connotation that you might transfer funds into another vehicle. We're not doing that. This is all about existing closed-in investments. So we're making that change. We're giving Steve actually another tool by indicating that he can sign on behalf of CERS when a general partner is making a request for an existing closed-in vehicle investment. So we're giving another tool to Steve, and we're adding some additional language. That additional language is that staff is to notify the consultant whenever they've received this type of a request in sufficient time, and we understand that sometimes sufficient might be truncated, but in sufficient time that the consultant has the ability to do independent research so that they can provide a memo to the committee as well to accompany the staff's recommendation. So that really is what we're doing here. But the crux of this, and I want to spend a little time talking about this. The crux of this is that this section gives the committee, the board chair, the investment committee chair, and the CEO. 2 of the 3 can sign a document to Steve, which would give him the authority to do a continuation of a fund that's been requested by a general partner, oftentimes in relatively short notice. Now, we've executed one of these thus far. And I think the changes that are being proposed here tighten our language so that there won't be concern going forward. But I will say that there was concern about the one that we did. In fact, we received an unsolicited memo from KPPA Legal that basically said that we were outside of our policy by having done what our IPS stated. Now, I asked our counsel to look at that once we received the memo, and our counsel looked at it and basically signed off on what we had done. So at that point, our expectation would have been that it was done, that our council had determined that we were inside of our policy, and that would have been the end of it. But I must say that even with our council having determined that there was still KPPA staff who tried to argue again that, well, there are two competing memos here. I take very seriously the fiduciary responsibility that I have, and I'm not suggesting that everyone around this table and everyone on this Zoom doesn't. We all do. But what we've done by allowing 2 of the 3 to sign off on this is to reduce the amount of money that we take from the trust to convene a committee meeting and convene a board meeting, $1,200 from the trust for a 10-minute meeting in investment and a 10-minute meeting for the board. That to me doesn't make sense, and it's not a good use of the resource that we're entrusted to preserve. We also, by doing it this way, we establish an audit trail that did not currently exist, so that we can go back and look at the number of times that we have signed off on a request from general managers to extend a fund. We not only do that, but we ensure that there is committee and board oversight, which is something that prior to our having established this, there was no committee oversight. There was no board oversight. Investment simply did it. So what we're being told is that in essence, we should go back to a time when there was no oversight of this process, because the technicality of it is such that some believe that it's outside the policy. Well, I appreciate the hard work of everyone, but once our council spoke to it, it was spoken to. So I apologize, Mr. Chair, for that little diatribe. That's all I'll say about it. But I do think that these changes to this policy strengthen it, make it clear what it is that we're trying to accomplish, and put us in a position where we can continue to be the good stewards of that which we're entrusted. Thank you, sir.
Thank you, Ed. Are there questions or comments of Ed about this proposed change in our investment policy statements? Hearing none, is there a motion to approve the amendment to the investment policy statement as presented?
So moved.
Hold on, Bill, I think that's a comment.
Yeah, there's a couple hands up.
Is there a second?
Dr. Hackford, I think Bill's got his hand up, and I think Steve had his hand up. Sorry.
We can have conversation after the motion's been made and seconded. So,
All right. I'll second the motion then.
procedure. Thank you. Okay, we can proceed with questions. Bill, please.
Well, I'm just not up to date on the nuances of the comments. So could somebody explain the difference of opinion that was between the two legal eagles involved in this? Would that be Nathan?
I can speak to it a bit.
Okay.
So I think the difference in opinion comes down to almost technicalities. So I read the current version of this subsection D to mean that the investment committee has delegated authority to essentially continue certain investments to two of the three persons listed in the policy already. It's a little unclear, and I think these changes are a good addition. When something fits into co-investment or continuation vehicle, I view it as the intent of this is to not essentially create a complicated process for extensions, contract extensions, essentially. And having looked at the investment at issue, I think all three people signed off on it. I don't think it's in violation of this policy, but I do like the additions in the red line because it takes any question of whether or not this authority has been delegated away. It makes it a lot simpler to understand because, as we all know, these are very complicated investments. These contracts are sometimes hundreds of pages. And a lot of times they are on shorter timelines. So I think this is a good change to kind of streamline the process, but also make the delegation of authority clearer.
That help you, Bill?
I think so, but what was the KPPA's objection? That's what I haven't got straight.
I've taken KPPA's objection to be what the extension was not a co-investment or continuation vehicle, but was a contract renewal. And I looked into it. I believe that it fits into one of those two. And I think the policy is really trying to encompass contract renewals in general. That's I think where the disagreement is, the scope of the current policy versus what was done.
What is Steve? Do you have comment?
Yeah. Sure. I think KPPA's legal position was that exactly as was mentioned, this was an extension request. It's not a renewal. It's an extension of an existing contract. The terms of either an investment period or the maturity of that. It's not a co-investment. It's not a continuation vehicle. Most those are two new investments. It does not fall as clearly defined below. It's not either one of those. So I think Eric's comment is whether the intent of the language as it existed was to include existing investments as part of the co-investment and continuation vehicles in the spirit of that language. I think it was more his view was the intent there relative to KPPA's legal interpretation of the black line of the existing policy.
And we're our own entity, but do we have these same nuanced problems with K side?
K does not. K has delegated those decisions to the CIO and the investment staff.
Okay. Nathan,
I would say it's also a mischaracterization of some things like investments doesn't just do things. I think there's for different things, like Steve said, co-investment and continuation vehicles are separate new investments, and that's why we need approval, because you have to sign a new legal agreement to do new legal negotiations. It's a new vehicle. That's why we have to come for approval. We don't just do anything. And extensions are not new investments, which I think is what Steve was talking about, but also those are things, again, we would recommend, and then you can approve it or not. But oftentimes it's going to happen whether or not we recommend it or not. We're going to be 1 or 2% of some of these old funds, and it doesn't matter what we vote or say, it's going to probably happen. So, so to have discretion for Steve, it doesn't actually give discretion, right? It takes it away, and it cuts two investment committee members, like including yourself, out of the process, right? Because discretion would it'd be like what Kay does, like where the investment team, has oversight, like we always do, and um, and then we can obviously answer any questions, like if a fund is old and they're like, hey, did they get extended? I'd be like, sure, yes, it did. Majority of investors decide to extend it for 1 more year or 2 more years or whatever, and then that's what would happen. So it's not like nobody's looking at it. I think that was maybe an interesting interpretation of that. So yeah, I just wanted to clear that up. Like, yeah, people are looking at it. There has not been no oversight. Obviously, we've had many of these funds for many years now and are well aware of what's involved there and are paying attention.
And I appreciate the effort to clarify, and I absolutely understand the need that you don't want to have special called meetings, and it's unfortunate we've had to call someone very short notice in order to have votes and ratifications taken. But my initial comments on this would be, I think you really, it's trying to address three things: co-investments, continuation vehicles, and existing investments. And I would keep the co-investment as part of that policy, because those all three are very unique and distinct things. They have different meanings. And in fact, on that first line, co-investment, comma, continuation vehicles. My other question is it specifies to provide CRS consent. As we've seen with our recommendations, oftentimes our recommendation is not consent. We vote against or we abstain. So if we could change that to something about providing response to the request as opposed to consent, because I don't think we want to limit this to, because again, if we voted against it, right, if our recommendation is to vote against it, I would read this to mean that we still need to call a special called meeting. And that may not be correct, but if we could modify that so we can respond to those requests with the approval of 2 of the 3, as opposed to providing consent. The only other area I really, I would strike the consultant receipt of any extension, if that's fine. Is it just extension, or we've brought other things before the committee that are not necessarily extensions of a contract? There can be changes in terms that we feel the committee needs to review. So I don't think we need to limit it to Wilshire's, allowing them to opine just on extensions. And specifically for co-investments, that's something new. We've never brought co-investments to Wilshire. They typically have provided their opinion at the original approval of the investment, which often includes the co-investment sleeve. And I think that to me, I don't think that would be Wilshire can certainly opine there as well, but I don't think that would be part of our investment process, would be to get Wilshire's opinion on a co-investment.
If I may jump in, from a policy compliance standpoint, I agree with what Steve said about consent versus response. And I would also just note that it may be difficult for KPPA staff to comply with this policy as written, based on the language of provide CERS consent to general partner requests relating to existing closed-end vehicle investments. The KPPA receives requests relating to these existing vehicles that go beyond extending the fund. There are other sorts of requests that may come through. So just to make sure that KPPA staff know what to do under this policy to ensure compliance, it may be helpful to tease that out a little bit or be more specific to situations where the funds are being extended.
I appreciate the comment, but this is a very narrow policy. We don't need to modify it to fit every circumstance. It will never fit every circumstance. We're only, when the request is for extension, is the only time that you would use this part of the policy. Why would we try to make this fit for every circumstance that could occur. It's not intended to do that. Because if we look at what we've seen in the 7 or 8, no, not 7 or 8, the 4 or 5 specially called meetings that we've had, they've all been extension. So we can say that it needs to fit a number of other things, but what we've seen is extension, which is what this addresses.
So for the situation that we had with Adam Street, would you consider that then we would need a special called meeting? Because that was not a fund extension. It was a change in terms.
Absolutely. Absolutely, we would need a specially called meeting because the board nor the committee has delegated to these 3 individuals the ability to change terms.
It's just the extension that you're talking about, right?
Correct.
Right.
Well, it says co-invest as well in continuation vehicles. So there's 3 things that are involved in this, I think, if I read it right.
I see that it's struck in the title of the subsection D, but it still appears, co-investment still appears in the body of the paragraph below subsection D.
Mr. Cheatham has his hand up.
Lyle, please.
Yeah, few things. Number one, I agree that we need to streamline this issue when it comes to extensions. Just as Steve said, in most cases, no matter what our ultimate stance is, whether we're for or against, it's going to be irrelevant when it comes to dealing with these types of investments. Yep. But at the same time, we have to be able to sit there and show whether it's a paper trail or how you want to term it, of a reasonable level of oversight. So to remove this from any type of oversight, to me, would be a step backwards for us and for the system. When it comes to, and I can't remember, Steve, you can refresh my memory. The one that we made the change from going from a existing investment to a co-investment. If I recall correctly, if we did not do that, we would have basically lost some funds due to the haircut. Is that not correct?
That was for a continuation vehicle. You're correct.
Yeah, they're not the same extension. It's different.
Lyle, if I may interrupt, I do have this drop-off requirement. Could I turn the meeting over to you as co-chair, as vice chair?
Yes.
Thank you very much. Thanks for doing. I may be back. Should be a short intermission, but I've got to do this. So thank you, Lyle. I appreciate it. Okay.
We will move forward and look forward to return.
So in a continuation vehicle, typically assets of an existing fund, it's moved into, those assets are moved into a new fund, and existing investors often have an opportunity to maintain their investment or to sell. We saw a rise in continuation vehicles, or the market has, primarily as an opportunity for liquidities in frozen markets for LPs. So you're right, the continuation vehicle that was most recently presented, I think we presented 2, was an opportunity to maintain exposure to that investment as that investment was sold out of our existing fund and placed into a new fund, which is the continuation vehicle fund.
And if I recall correctly, with no additional fee. Fact is, I think it was a fee reduction or elimination. Is that
correct?
Not
correct?
Okay.
No, I don't think that's true. We still pay fees for these.
It was a lower fee than it was all in.
Yeah, it can't be. Well, specifically the energy one, I think our predecessors who agreed to that had a no fees after extension, which was honored by the sponsor. So that's why that happened. But the other ones, the toll road does have fees, and because you're in a new vehicle, right? They've reset the fees and things like that, and so yeah, that it incurs fees. For the Kane one, the management fee was taken off because of, they're, I think the ILPA guidelines are to try and keep people absolutely equal as if it never happened. So in that spirit, I think that they're trying to maintain that for us. And so, but that was one where it was very oversubscribed, and so we're not able to add to it like the toll road one. So it's on a pretty small amount of money. Obviously, we got more. Well, on the case side, we got more exposure to that through the fund that invested that. So, but in terms of that, yes, the management fees cease, and then the carries still. I think there's still fees potentially in there. So.
My point in all that being, in most cases, as Steve pointed out, what your recommendation and what our ultimate stance is a lot of times irrelevant.
For extensions only, not for continuation vehicles or co-investments, only extensions. Yes.
Going to Carrie's concern of over the term of consent, there may be a better term, but as I understand the policy, the way it is written, using the red line version, it is your all's responsibility as the investment office to come to at least two of the three members outlined with your recommendation. And based on that, it would be their consent to that recommendation, one way or the other. So, you want to toy around with the word consent as it applies, and looks like approximately line 5 or 6, depending on how you count them, to either consent to the recommendation of the investment office or not.
That makes more sense. Yeah, that makes more sense than consent to the general partner's request. I think that absolutely would clear that up.
To your other point, Steve, and I'm just speaking in this case for myself, no matter what the continuation vehicle is or the co-investment is, I always want to hear, from, in this case, Wilshire, as to their feeling about that. I think that is pertinent. I think it, not only goes to our fiduciary responsibility, that I would think it would certainly go to your all's as well, to have an outside firm opine on what on your recommendation. So, if you want to make that change to that line on consent to the investment office's recommendation, I'm fine with that change.
Wouldn't we also need a change in the first line to delete continuation vehicles?
Honestly, I would be more inclined to, leave all 3: co-investment, continuation vehicle, and existing investment. I don't know, Ed, if you would want to give us your thought on that. Be interested in hearing it.
Yeah, I don't think that would be a problem. We wanted to remove continuation vehicle to remove possibly any thought that we were talking about transferring funds. Because when you talk about the transfer of funds, you possibly bring in the procurement policy and that, so we wanted just to back away from that so that there would be no confusion. Concern.
I can see that. I can see that.
Doesn't bring in procurement policy at all. It's just a response to an investment. Like you have a decision that has to be made. Either if you do nothing, they will just sell it, and so it's not. You have to actually affirmatively want to stay in, or it just gets sold from you, and that's it. So it's not a procurement thing at all. So I mean, if you want to keep it in to have it opine on that, that's good. But ultimately, if you want to reduce meetings, the answer is delegation, right? You just delegate it like it is for K. Like we don't have to, we can answer any questions you like. You have 55 line items. I can tell you whenever there's an extension or whatever. And if you really want to know, I mean, great. But what this actually does is not provide delegation. It again cuts 3 investment committee members out of the decision. Is what it does. So
I appreciate that, but that's not in the cards. We're going to provide oversight to our funds.
that's fine, sir. Absolutely.
Ed,
You will have more meetings. Is what it will result. But yes.
Vehicle needs to be removed. Is that correct?
Yes,
Okay. So you're saying it should be co-investment and existing investments.
correct,
Is that correct?
correct.
Okay.
Well, again, help me with the nuance. I was getting confused between co-investment, continuation vehicles. So what is existing investment? What would be that category?
It's what we're discussing, Bill. As Anthony mentioned during his presentation, primarily we're talking about legacy private equity investments that are several years, if not a decade old, where the manager has come at the end of that fund cycle to ask for an extension to the fund.
And that's not a continuation vehicle?
No,
No.
they're different things.
So are we carving out continuation vehicles from this process?
Yes,
So again, first line item D, co-investment and existing investment policy. Seems like we're missing, there ought to be something in there to identify what we're talking about. But anyway, down on line 6, to provide CERS consent to the general partner based on the recommendation of the investment office would be the addition to the line. Is that correct?
yes,
Okay. Eric, does that make sense? Follow your thought?
It does.
Okay.
And-
Go ahead, Bill.
Well, what was this reviewed by the investment office?
We received it when the material was sent out.
It's clearly been through all the legal departments apparently. So
Answer your question, no, our opinions were not asked, Bill. That's the answer. No, we were not asked. We received it like when everybody else did. Yes.
Well, it's a good team effort.
we work with our investment advisor to make the changes.
okay.
And to your response, or to your question, Vicky's on vacation, and so if she or Michael, who's not here today, reviewed it, I can't answer to that. I wasn't involved.
I think
Well,
based on
Mr. Cheatham, my only comment to your suggested edits I would recommend keeping continuation vehicles in. I mean, that was added. This originally was just a co-investment section, and that continuation vehicle language was added. You guys added that specifically not to require the specially called meetings when timing was a consideration. So I don't think it makes sense to remove that from this one. In fact, if you're looking just simply to extend it to include extensions of existing investments, I think that's certainly reasonable, but I wouldn't remove continuation vehicles. The 3 things are co-investment, continuation vehicles, and extensions of existing investments.
Okay.
Oh, I like extensions. That helps me understand what's going on.
Mhm.
All right. So,
I-
Steve, co-investment, comma, continuation vehicle extensions. Is that what I'm hearing?
Continuation vehicles, comma, and extension
Existing
of
investment.
existing, yeah, extensions of
I
existing
knew
investments or
there was
something
a
like
word
that.
that was missing. Okay.
So then the first line would then be adjusted to say that as the title.
Okay. Anybody else have thought on that? JT, I know you're sitting there amongst them all. You got any thoughts on that language?
I don't like that language.
Okay. All right. So I
Could
guess
we carry that language through to line 6? Or do people still want to go with the or to provide CERS's consent to general partner request as recommended by the investment team relating to existing closed-end vehicle investments? From a compliance standpoint, I think just coming out and saying extensions of existing investments or existing funds would be cleaner and easier for staff to follow.
I'm sorry, Carrie, you broke up and I lost the last little bit.
Looking at line 6, which was previously discussed, as to changing the consent language to recommendation by investment, KDP investment staff language. I think from a compliance standpoint for the staff, it would be easier to follow if we just came out and said, or extension of existing investment, request for extension of existing investments or existing funds, in existing closed-end vehicle investments or something like that. Just come out and say it on that 6th line.
Okay. Eric? That looks like you're
I'm
sitting there.
reading, but I'm trying to follow along and listen to everybody and parse it. I think, to back up just a little bit, that this is really about what delegation the investment committee wants to give to other people. I'm reading it and, you know, not to rehash it, but, you know, there's 3 things at issue. If continuation vehicle is something that the board and the investment committee do not want to delegate, it comes out. But otherwise, I agree that the language just needs to be harmonized throughout. And, you know, I think what we've discussed does that. But it might be something, I'm kind of hearing different opinions, and it seems like maybe people are a little bit confused about what they want out of this policy. So it's hard for me to give a direct answer to that. I'm sorry.
Okay. Well, let's back up. And let's do this individually, and maybe that will trim things down. The first line, you know, as it stands right now, the proposal is for it to simply say co-investment and existing, and what did we come up with a minute ago? Existing investment continuation policy.
I think it's co-investment, comma, continuation vehicles, comma,
Well,
and.
That's option B. Yes.
Okay.
Yes. I think option A I would be co-investment and existing investment continuation policy. I think we're missing. That was the word I was looking at that I felt like we were missing.
Extension, yeah.
Okay. So I'm just going to do this round robin. I hate putting people on the spot. You know, I can certainly see the concern on the issue of continuation vehicle, because it really would be a, well, I don't know, would somebody from Wilshire
Yep.
answer this question for me?
And I might make a suggestion, just listening to some of the concerns and comments, you know, across the committee and staff. We could revise the language to accommodate and propose it for a future meeting where it gives everybody time to review. You know, I think we could probably, you know, take some of Anthony and Steve's comments on consent, because there is a negative, you know, providing not just consent but a negative could be applied here. Although I think the and other administrative or investment approvals kind of captures that. But we could change extensions to amendments, which will apply, will capture, you know, the other 10 or 20% of requests that the GPs send in this in their typical requests.
I understand that, but I also appreciate where particularly Ed's coming from, that we want this targeted.
Yep.
You know, I don't think we're trying to solve 20% of those issues. You know, my question to you is going to be, of the two types of investment, a co-investment or a continuation vehicle, which of those two would you consider to be more of a new investment?
A co-investment is definitely a new investment. Typically, you might already be in it, but you're making a new investment. A continuation vehicle can be a new investment if it's not one that you're already invested in. Oftentimes, people are making GP commitments to continuation vehicles that they're not currently already a part of, which would be similar to a new investment. But in all cases, you're making a decision. Like if you're already in the existing investment, the continuation vehicle, you know, you have to make a decision of either getting out, oftentimes at a discount, or continuing on with that investment. Typically, we would see that, especially when time sensitive, an approach like this where staff would make the call with a you know, kind of a more expedited approval. I would say co-investments are a much you know, typically something that would be applied in a similar policy as a new investment.
All right, let me put this out for consideration then. As far as that line's concerned, change it to co-investment and continuation vehicle of existing investments policy.
I like the comment that the people that understand all this and all the nuances get together and come up with a proposal for us to review. We've got so many different wordings on different lines. I'm having a hard time keeping up.
Okay. JT, you got any comment on that? I'm going to take Bill's comment as he's wanting to make a motion to table. Would that be fair to say, Bill?
Only question would be if there was a time, if there's a time that we need to get it done quickly.
No, we can.
No, but I'm good.
Procedurally, is table the proper approach now? We've got a first and second. This is all discussion. So yeah, I guess I'm offering a motion to table.
Okay. As I said, we got a motion. Is there a second to the motion to table? JT, that only leaves you, buddy.
Second.
All right, I got a motion and a second to table with the instruction for Ed and Wilshire and Steve to draft and Eric a more pertinent, appropriate language, but I still would like to see that targeted and not some broad something that gets out into other areas. But you know, I'll leave that up to you guys to come back with the recommendation for. All in favor of the motion to table signify by saying aye.
Aye.
All opposed? Ayes have it. So I look forward to a special meeting to deal with this.
What do they do with the other motion on the floor? There was a motion in a second. Does it?
All right. I'm going to
That's what gets tabled.
go back up to the start of the original agenda. And I think, Craig, Chris, this would be your all show with the forward-looking economic outlook. I noticed you all had a pretty significant amount of material in the packet that I look forward to hearing your interpretation of. I think we're at a point economically that, you know, we need to start looking forward to changes in markets and what that means for our investment portfolio.
Thanks for that, Lyle. I think that tees us up well here. But a lot of our slides you'll be familiar with are focused on what happened in the second quarter, but we'll try to connect the dots to how that relates to our projections going forward. If we start on page 17, part of that rehash of what happened in the second quarter was just to discuss some of the heightened volatility we saw during that period, and obviously I'm sure everyone's familiar with the volatility we saw in equity markets, and Chris will get into a bit more of a market review after some of these economic comments I'm making. But we also wanted to highlight here, this is a chart we've shown for multiple quarters in a row now, a breakdown of what was happening in rates. So here we see the 10-year nominal on the top. That's the 10-year number you see on CNBC or scrolling through whatever website you're looking at. But then it breaks out below into the components of the break-even inflation rate that's derived from that 10-year rate, and TIPS pricing, so that what's the market pricing in terms of inflation, and then that red line in the middle is your real yield, so the yield above inflation. So those two lower components combine to make that upper component. So you can see the green to red line represents the second quarter. We had an initial drop going into Liberation Day, and then a spike in rates. And more than what was going on in the equity market, it might be the fixed income market's reaction to the tariff announcements that caused some of them to be put on hold. The level of disruption in fixed income markets was pretty drastic. You can see here the real rate in the middle section there jumped dramatically as rates rose and inflation expectations actually moderated slightly. As we moved through to the end of the quarter, you can see after that red line, we saw rates, both real and nominal, start to rise after the end of the quarter. So today we sit roughly where we sat at the end of this chart in terms of break-even inflation. It had risen to 2.4%. The 10-year around 4.3% today, and because of that break-even rising, that means real yields are down below 2% again today. If we move to the next page, so what's the market expecting for rates going forward? You can see the dotted blue line indicates this most recent July Fed meeting. Early in the year, the expectation was that we'd have a cut by by this July meeting, and then you can see that line move up to zero, and that is what the Fed did. They left rates steady. The red line is the other one I'll draw attention to here. That is the implied number of cuts by December. So you can see now on the far right there, the market by the end, this is going through mid-July, the market was expecting 2 cuts down from 4 earlier in the year. So you can see that April 30th number in there. By the end of April, the expectation for cuts reached its maximum, looking at potentially 4 by December, and then a further cut into next year in March, possibly June. Now it seems like the market settled on closer to a probability of about 2 cuts this year, September, December being priced in at this point. And part of the uncertainty on the next page, we see tariffs definitely causing some of the uncertainty in markets, along with other potential policy decisions. You can see here the average tariff rate is 4 to 5 times higher than it had been for the last few years leading up to this, and there's still plenty of uncertainty as to how some of these deals will continue to play out and be negotiated. But this is looking at the actual rate that has started to take hold and is in effect today. I think in some of the more recent inflation data, we're seeing that although these tariffs hadn't been initially passed on, that certain goods such as appliances that are more susceptible to some of these tariffs have started to see some price increases. So it's still very much following this theme of uncertainty as to how much will be passed on versus how much will be borne by these companies. I think it's fair to say that no one can realistically expect the companies to just swallow a huge increase in cost and allow their margins to be taking the hit fully if they think they have the pricing power to pass some of that on. But we'll see what that split is. Obviously, a tariff is a tax, so someone is paying it at the end of the day. I'll skip forward a couple pages here in the interest of time. On page 21, again, as we think about big picture themes going forward, not necessarily something that we have an exact time frame on. This could be many years before we really feel the full effects of this, but this idea of the potential for our debt levels to seriously impact our potential investments and economic prospects. We can see here this the red and black line showing public debt and GDP, and the dotted line showing a ratio. And you can see that we have this initial jump around the GFC to about 100% debt to GDP ratio. And then that red shaded portion is a period of time where you would expect that in more reasonable economic times, we'd be trying to pay that debt back down and return to normal. The idea is that if you break the glass in case of emergency, once the emergency is patched, you put a new glass pane up and you're ready for the next one. But instead, those high debt levels were maintained, and then we went into COVID and we're forced to kind of pull out the emergency measures again and further push our debt level up to now we're 120+% of GDP. And obviously there's the right time to dip into savings and the wrong time, and you can't constantly do it without facing some consequences eventually, which we'll get to in a second. On the next page, again, this is just a chart that shows that historical relationship by comparing the deficit as a percent of GDP to unemployment, and you can see that historically had a very strong relationship. Unemployment gaps out, and government spending steps in to help ease the pain. And then when the employment situation and the economy as a whole has some chance to recover, that deficit is allowed to shrink and go back to more normal levels. And you can see with those two black bars on the right side of the page that relationship really didn't hold. The drop in deficit never really went all the way back down to the levels we had seen before in terms of that connection to unemployment and deficit spending. And to the consequences on page 23, if it's you, me, or some company, there's limited options. You pay the debt back, or you default and have to restructure, declare bankruptcy. That those are both painful processes, right? Paying back requires you to not be spending the money on other things, and defaulting, probably results in a bunch of your stuff getting seized. So either way, that's painful. Governments have a third option, which is to just print more money, which is easy in the short term, but has a different kind of pain associated with it longer term. And as we again think about this as a kind of an emerging potential long-term risk that we're not saying we need to react to in the next quarter or maybe even year or several years, but something to think about. What are the assets that maybe should be incorporated in our portfolio to help insulate us to some extent? And you can see here the plan B, B being the Bitcoin logo. I don't know if the institutional investor has decided now or not at this point if Bitcoin has a role to play in institutional portfolios, but it is gaining some traction and discussion. But other assets that you would have already in your real return part of the portfolio, things that have scarcity associated with them, like gold, commodities, real estate, things like that. If we are going to print money to get our way out of this issue, then inflation becomes a bigger and bigger concern over time. So that's something that's on the forward-looking radar. The next few pages have some more detail on this idea of our debt and deficit issues, and on page 26 we see, for example, another example of a historical relationship that is broken down, and here we've got those real yields from the 10-year that we hit on the first slide. That's on an inverted axis, and we can see that historically, as real yields fell, gold performed well. What we've seen in the last few years here is this breakdown of the relationship where real yields rose, but gold prices also soared. So these are two inverted axes. So when they move apart from each other, they're both rising. So higher real yields, but gold doing extremely well. And it's hard to pinpoint exactly what's driving it, but I think there's a number of factors, one of which, at least some component of it, is probably waning confidence in the ability to hold U.S. treasuries. There's also, some nuance with, central banks around the world building up more and more gold after seeing what happened to Russia when they were essentially frozen out of the financial system. Maybe the idea there is that gold is something that you can buy up and store in a vault somewhere, and you can't just be kind of cut off from the system and told that your money is frozen somewhere. So a number of factors going into this divergence, but again, something to keep an eye on longer term. Just a couple more comments. We've got our typical slides starting on 27 on some economic factors that we typically update you on. GDP growth, we saw a contraction in the first quarter. I believe that negative 0.5% was revised to be a little less severe in the second reading, but then we saw the initial reading of the second quarter GDP growth at 3%, with the second reading of that, I believe, coming tomorrow. So we saw a lot of things snapping one way and then the other from the first quarter to the second. U.S. equities, imports, a rush of imports before potential tariffs, and then snapping back the other way in the second quarter. GDP growth was negatively impacted by that huge surge of imports in the first quarter, but bounced back strongly in the second quarter. On the next page, another one that we've been mentioning for a while, and is something that we're keeping a close eye on, to your point, Lyle, about what we're thinking about for the future, is the consumer. We saw a steady improvement in consumer confidence for a number of years, and then a pretty severe drop-off earlier this year. Part of that's probably due to the wealth effect, as U.S. consumers with potentially a lot of U.S. stock exposure saw their equity sell off and their net worth decline in the first quarter. That makes them kind of think about their spending a bit more. If they see their net worth dropping, we see a bit of an uptick there into later in the second quarter. So maybe that's a part of it as U.S. markets recovered. But something we've been pointing out for several meetings now is that the gap in sentiment for today versus the future persists, where that the consumer is more pessimistic about the future than they are today. So we've recently seen their opinions of the current situation declining a bit, but that relationship of future versus today, as I've said multiple times now, is a potential self-fulfilling prophecy. At a certain point, if you're that worried about the future, you start to adjust your current behaviors, and we have seen for several years now an uptick in the savings rate on a real on a dollar basis, but also on a percentage of basis, people saving a bit more than they had been before. And that could be another sign that they're preparing for leaner times ahead. And then I will end on page 30 before I hand it to Chris. Inflation, we've seen improvements as we've discussed before. Goods inflation has cooled down, but services remains pretty hot. Again, the housing portion of that is a sticky component that takes a while to move, but a lot of that is people shifting from buying goods during COVID and shifting to services and going out to eat, taking vacations. Airfares have been pretty volatile. So we've seen inflation kind of stuck between 2.5%, 3%, which is a bit higher than the Fed's stated mandate of 2%. But I'm pretty sure if we could get consistently closer to that 2.5%, then maybe they'd be a bit more comfortable with the pressure to start cutting interest rates. And then from the employment picture, again, we've seen steady 4% unemployment. That's really it's trended in a very narrow range for quite some time now. But the headlines were more focused on some revisions to data that came out earlier this year because of the steep revisions downward for, I believe it was May and June, for claims that resulted in an official being fired by Trump. So throwing a bit more the increase in uncertainty around the reliability of that data is not a good thing. I don't think it matters what you expect the reading to say. I think that any market participant would want that data to be as apolitical and consistent as possible. And there's concerns on both sides with how the revisions were so severe and how maybe the polling and sampling for that had changed over time. And on the other side, people getting fired for releasing numbers that you don't like is not a good look on the other side as well. So concerns from both sides, and at the end of the day, the market participant is the one that loses if we have a deterioration in our confidence in that data. So with that, I'll turn it to Chris to talk a bit more about what we saw in markets during the quarter, unless there's questions.
Just one question, Craig. You skipped over your page 20 slide. You mind touching on that one?
Or did you say 20?
Yeah, page 20. Be your slide 8. No, I'm sorry. I flipped over.
Yeah, this is speaking to the U.S. dollar total return here, and what we're displaying here are half year, if you will, returns of the U.S. dollar going back to the 1970s, and you can see here that the second quarter was one of the worst 5 performing quarters not quarters, but half year periods over that time. So U.S. markets have, specifically the U.S. dollar, has seen quite a big, run up versus other fiat currencies. And, if we were even to look at it today, we could even make the argument that the U.S. dollar, while it's come back versus some of those currencies, could still be a little overvalued, but it's been a particular, tailwind for non-U.S. equity investors. Because the U.S. dollar has depreciated, and the idea here is, whether Trump came out and said it very specifically or not, but by bringing the U.S. dollar down, it makes our net exports look more attractive to non-U.S. regions and countries there. So the U.S. dollar has faced some headwinds over the most recent quarter. And we're not calling for a turnaround in anything on this, but it is something to keep an eye on because the U.S. dollar has depreciated versus other currencies.
Pardon me, I apologize for departing for a while. Are there active estimates in terms of the tariff sales tax in terms of federal revenue?
We did have a slide, it might have been the next slide right after this one. Nope. And I apologize. Let's see. Could go back a couple slides here.
It seems kind of interesting that
There it is right there.
right.
So you can see that through the first couple of months of second quarter, the tariff revenue did start to increase. And as Craig was mentioning, the ability for companies to just absorb those cost increases, to date, they've done most of the absorption. It hasn't necessarily been passed through to consumers. To think that that's going to continue would probably be a little naive. I think at some point there will be a one-time hit to consumers here where you will see that kind of inflation kind of hit through to the end consumer. But as far as actual numbers, I've heard it thrown out maybe 2/3 of the cost might be absorbed by producers as opposed to the end consumer.
It really doesn't matter who absorbs it. In effect, the tariff will still generate revenue.
It certainly will.
And I
It
guess my
doesn't matter if
question,
the company's paying it or the consumer's paying it. It will.
question is, are there estimates of what that's going to generate in terms of an offset, in terms of the budget deficit?
I don't think we have. There likely are estimates. I don't have that number off the top of my head, and we don't have it in this deck, but I could circle back with you. We can look that number up.
The St. Louis Fed has some good data. The Fred data on tariffs and impact on revenue. I think it was second quarter is 266 billion.
So far, it's sort of a hidden sales tax, and once it is passed on, I think there will be some resistance. So it may be just a temporary revenue source that I think Trump's depending upon as to being an offset, and therefore they can talk about how this new revenue source, but people are eventually going to realize it's a sales tax they're incurring.
If we could move to slide 31, and it was just a few months ago we were talking about and having just gone through this with the K side last week. I know Steve is keeping a tally of the word uncertainty and how many times we've used it. Thinking back to late March, early April, uncertainty was certainly the theme of the markets. And if you recall back to first quarter, really it was the real assets that were kind of the ballast in the portfolio, along with fixed income as equity markets sold off. Then we had Liberation Day at the beginning of second quarter. And ever since the Liberation Day and when we put a pause on those tariffs, equity markets have really rebounded quite issly. You can see that for the quarter, the US equity market returned 11.1%, largely driven by large caps, although small caps have had a nice quarter at 7% up. And you can see that large growth outpaced large value to the tune of almost 20% for large growth and just about 4% for large value. So once again, the large growth really did kind of drive the performance, and that's supported by the chart underneath where you see information technology really led the way, as well as communication services. But small growth also outpaced small value. And if we go over one column just to the year-to-date numbers, equity markets are up almost 6%, with large cap really driving that up almost 6.5%, and small cap being relatively flat. Large growth and large value are nearly identical. So value did outpace growth in the first half or the first quarter, but growth did make a resounding comeback in the second quarter. And then small growth and small value relatively equal at negative 30 basis points to 10 basis points. Going down again to that lower left corner in the U.S. sector weight and return, again, IT, communication services, many of the sectors were positive. Really the only two detracting in substantial ways were healthcare and energy over the most recent quarter. And then on the right-hand side, these charts show the quarterly excess returns of large cap versus small cap and growth versus value in the dark blue bars, with a rolling 3-year excess return in the light blue line. So once again, large cap has outperformed, small cap continues kind of that run that it's been on, and growth made a good rebound off of first quarter, where you can see that negative dark blue bar. For first quarter, it had a kind of a equal and opposite reaction in second quarter, and it's put that large growth versus large value rolling 3-year excess return kind of up above 10% again. If we go to slide 33.
Chris, just want to point out that I rambled on a bit, and there's 15 minutes left, and I know Steve's got an update as well as a budget update. So, my apologies for that. I left you with the short end of the stick here, but
no problem. I will try to move through this fairly quickly. This chart really just kind of wanted to get to the banner performance that U.S. equity markets have had going back to 2005. You see numerous years where we've had double-digit returns, and those blue diamonds show the largest sell-off during those periods. So this is just a reminder that even when there are market sell-offs, really to stick to your rebalancing and your target strategic asset policy weights so that you can participate in those rebounds. It really just is a testament to that. If we go to slide 36, I will talk about non-US equity markets here. And this is a kind of new phenomenon, if you will, where non-US equity markets have really outperformed US equity markets. So you can see here over the quarter, the ACWI ex-US over 12% up, and that's really kind of equal between EFA and emerging markets. And if we look over to the year-to-date numbers, you can see across the board in developed and in emerging markets, we're up in the mid to high teens with the ACWI ex-US up over 18%. You can see in the lower left-hand corner, various countries are really participating quite nicely to that. Germany had a nice rebound with some of the government expenditures that they're making. You can see that they've had a nice quarter at 17%, and they're up over 35% year to date. So non-US equity markets have really been kind of an area that has shined, and I know that's been an area that Joe and his non-US markets, his managers have done a really good job over the quarter. If we go down to fixed income on the next slide, you can see that over the quarter, we had a nice return of just over 1% for the aggregate. And more specifically, I want to call it the Treasury yield curve, which if you look at the dark blue line, that is where the yield curve sat as of 6:30, and the light blue line was where the yield curve sat as 3:31. So what we see is the short side of the curve coming down and the long end of the curve coming up, otherwise known as a steepening of the yield curve, which in reality over the quarter hurt some of the long-term maturity segments of the market, but ultimately we still getting 4+% over many areas of the fixed income market. So we've had a good first half of the year out of fixed income. And then I don't have a slide in here, but I would be remiss if I didn't talk about real assets because, as Craig pointed out, real assets are an area where if you do think that the government is going to print money and trying to kind of deal with some of the debt issues that we have, I just wanted to call out some of the real asset returns that we have. Wilshire, as measured by Wilshire's Global Real Estate, over the quarter, just under 2%, and up over 4% for the year. Commodities, while they did have a rough quarter, are up over 5.5% for the year. Gold has continued its remarkable run up over 5% for the quarter and almost 25% for the year. Bitcoin, whether that's institutional or not, you could make arguments, but over the quarter was up over 30% and almost 15% for the year. Infrastructure up almost 5% for the quarter and 10% for the year. And energy, a little bit struggling for the quarter, down just over 1%, but up over 5% for the year. So again, those real assets, something in an inflationary environment we would expect to be another ballast of the portfolio, has still proven to be a nice return stream year to date.
Well, thank you. I'm back, so I'll relieve you. Extra duty.
I would like Wilshire they skipped over what I consider the most important slide, and that was 16.
Oh, okay. So our asset class assumptions, which really are a byproduct, if we look at the US stock, you can see we're just over 4%. As market valuations continue to run up, that makes it a little bit harder and harder. We've essentially pulled forward-looking returns forward. And then really the kind of key component you want to see here is core bonds, which we have just over a 5% expected return on. We still do have a negative equity risk premium to the tune of 75 basis points. So again, we are expecting more out of core bonds over the next 5 years than we are over US stocks. And if there's any other areas in this particular assumption that you'd like me to touch on, I'm happy to do so. But that's really the theme is, a lot of our equity assumptions, because of valuations, because of the cost of capital, have come down a little bit, where your yield-bearing assets have moved up a little bit through time.
Yeah, I just want to point out here that the page Anthony showed before, some of your assumptions that we provided for that page are derived specific to how you implement. So for example, you'll see our private equity assumption on this page is only 6.2%, and on the other page it was over 7%. That's because for your portfolio, things like the deal you saw today, distressed debt and venture, they have higher expected returns going forward than this assumption here, which is more heavily U.S. buyout, which has a more depressed forward-looking return. So slight differences between what you'll see here and when we show you your projections based on how you implement and bucket sub strategies together. Just wanted to make that point clear because you saw two different numbers today, both called private equity.
My only question is not really on the equity end, guys. I would be interested in your thought with regard to what I would assume we were talking about as far as our expectation, as far as the U.S. economy anyway. What do you see as far as the risk associated with both high yield and private credit? Are you all looking at that as going up or kind of staying the same? Where are we at?
Well, when spreads are tighter, you are definitely getting rewarded less for the amount of risk you're taking, and I think with both of those categories, we would stress the importance of the managers that you select and their underwriting capabilities, particularly in the private credit space, where a lot of these deals are more esoteric and driven by relationships and lack of bank financing, requiring these managers to step in and provide financing. So it comes down to their team's ability to project the stability of the businesses that they're working with. And then on the public high yield side, it's your managers are trading from a set universe, and you would hope that their credit underwriting team is helping you lean into the more favorable return to risk profiles and away from the others. But again, it's with narrower spreads, you're getting paid less for that risk. But I don't think we've seen a material increase in defaults yet. I know we've seen some statistics that indicate that maybe there is a bit of pressure, not necessarily resulting in defaults, but other types of restructurings of debt that don't get reported as widely. But happy to follow up with more details on that if that's a particular area of interest.
Yeah, Lyle,
we'll be
the
sending out
our
quarterly assessment. We do kind of a mid-year or a little bit after mid-year review of each of the asset classes across private equity. So when we look at private credit, we break it down into direct lending, opportunistic, and distressed. Right now, we have kind of more neutral rating on distressed to cautious, where we're very favorable on opportunistic credit, where we think most managers are able to kind of take advantage of the market environment, and then also somewhat neutral on direct lending.
Okay. Any other final comments, questions? Well, sure. If not, Steve, you're on.
All right, thank you very much. Page 45, please. And just, Wilshire, you said uncertainty 18 times, just to let you know, so that was very consistent with the theme of the quarter. Unfortunately, I have a hard stop here, and so I'm going to turn it over to Anthony to cover performance and allocation section, which is a little disappointing for me because I always enjoy these meetings a lot more when there's positive performance to report. So, unfortunately, he gets to handle that for this quarter and this fiscal year. And I'm happy to follow. If you guys want to follow up with any questions, I'm happy to answer those. So, thank
You
you.
need to take a bow anyway before you depart.
Well, it was a good quarter and it was a very good fiscal year, so we're very happy with the results.
Good, we are too. Thank you. Anthony, if you would proceed.
Sure. Yeah, I think Wilshire gave you guys a good overview of the conditions and how things were. Like Steve and the Wilshire folks have said, volatility, uncertainty has been the themes. Obviously we know what happened in April. Things corrected, but now public equities are back at all-time highs. Spreads have tightened, and treasuries have now come down. But in the wake of all that, the portfolios rebounded a lot in the last part of the fiscal year. The last fiscal quarter was the pension and insurance returned around 6.3%, and so they both outperformed their benchmarks in the range of about 50 basis points. And so individual portfolios, it was in the 6.2 to 6.3-ish range. So that was obviously very strong given our assumed rate of returns for the years around that. So the largest contributors to the relative performance were public equity, as well as private equity, which has closed the gap on what we had a year ago when the indices had really ran ahead of the slow marks in PE, let's say. And then also the relative underweight to PE has been helpful as well, since it still is not, the marks have not just come back given the headwinds you discussed earlier that are facing PE. The non-US portfolio also did well. 7 of Joe's 8 managers outperformed their individual benchmarks, and the overall portfolio beat the index by over 130 basis points. So huge kudos to Joe. Obviously, we've had that tilt for a while. It's nice to have it to show. Let's see, the underperformance area I'd say for the quarter was really specialty credit. It was about 75 basis points below the benchmark, mainly because it has a little bit larger exposure to levered loans, and the spread tightening just did not happen there as much as it did for high yields. I think in line with other people have discussed how attractive credit is versus other things. You can see in the Wilshire assumptions, they're assuming higher returns for credit and high yield. But there is some caution given that spreads are like all-time tights. So that is something that obviously we're wary of, and cognizant of talking to managers about. We can't just we have to be careful on who we're going with and what strategies we're having. Although obviously having a base yield of in the 3s and 4s is much better than 0, so that helps a lot. All right, for the fiscal year, the pension and insurance were both up around 11%. I think the benchmark was on 11.27, and then the others were 11.65 for pension, 11.27 for insurance, so it matched it. So it was a pretty strong year again. Outperformance for the benchmark for the fiscal year was about $55 million of outperformance for the pension portfolios. So that's one for the good guys. And then so for the whole fiscal year, especially credit, real return, and real estate all beat their benchmarks, and those are the things that drove our performance. Real return was led by, I think our energy exposure really helped. Real estate and especially credit, did well. We did mention that defaults and stuff are starting to creep up, but the strong yields we've been having, and also our real estate exposure, which is mostly open and core, has started to rebound and had several quarters of positive returns now. So all those have helped a lot. Real estate by 350 basis points almost, and over 100 for specialty credit. Again, the non-US public equity overweight helped as well. And then the PE portfolio for the fiscal year was still a drag, but that's again because of the mismatch of public markings versus private. So I think we've discussed, we're working with Wilshire on the benchmarks. I think it's just, there are many ways to do it. We presented this exactly a year ago. Some of the different ways that different states and other investors do it. it's difficult for private markets, especially because they're not investable. But it's just kind of an illustration of what the overall portfolio is. The best way to look at it is fund by fund, but that's difficult with many line items. But you would see how the fund would have done compared to if you just put the cash flows in public markets, right? Which is how we view things, right? Like personally, I don't think we have to fill the private equity allocation necessarily. We're still going to do the best risk reward we can for the portfolio, because otherwise we can get risk pretty cheaply in Brian and Joe's areas. So unless it's going to be worth the fees, the leverage, the brain damage, the liquidity, I mean, we just don't really. We can get a lot of the similar risks elsewhere. So the goal of the benchmark, the recommendation is to hopefully have less short-term volatility. So at least the optics are not quite so jarring for folks. And obviously the transparency is there in terms of the line items, so you can see each individual component of it. So most likely, the recommendation would be to adopt a benchmark for short-term performance that aligns with portfolio, and then a longer-term one that is, again, for how funds actually act. So, but yeah, public market equivalent is kind of the standard, and I think we'll be able to speak more to that in the future. So, all right, we go to page 47, please. Internal portfolios were in line with expectations and all the objectives. Again, a lot of this is passive management, as you know. Again, speaking back to obtaining risk exposure cheaply. This is inexpensive beta to more efficient markets. I think we get there's obviously a lot of attention to fees and expenses paid, and this is very inexpensive. And so that's why I think it's important, and something that, Joe and Brian do a great job at. The proxy portfolios are also here for real estate and real return, while we find exposures that we want to be illiquid in and commit capital to. And then finally, I think a note for in Joe's area, the scientific beta portfolio was retired in June. That capital was transitioned to new large cap US public equity managers. And so that's what's happening there. If we go to page 48, the next page, please. All right. So the previous pages were at the trust level, and this is the individual portfolio level. So CERS and CERS hazardous. Again, from BNY, they can only show gross here. But I think there's work being done to get this on a net fees basis, and we'll hopefully roll that out to y'all soon. So you can see here, though, the tight dispersion of the asset class performance. Sometimes there's different allocations to individual investments across the plans, but since these have pretty similar risk objectives, there's not lots of difference here. So the one outlier, though, is the private equity, because there have been different allocations over time, and so some funds do differently than others, and that can affect some things. So, all right, page 55 next, please. A few more specifics. So this is in public equities. The global equity portfolio was up 16.14 against a benchmark of 15.89. The non-US is what really helped here. Actually, sorry, page 56 maybe would say that more better. Okay, and then so the non-US tilt definitely benefited. And so the non-US portfolio returned 17.95 against a benchmark of 17.83. So higher returns in US and higher than the benchmark. So that's definitely helpful. We go next page, core fixed income. So again, this was a good year. After all the rate hike problems that we had previously, the portfolio produced 6.27% for the fiscal year. That was above benchmark by 19 basis points, and also, again, right at our rate of return. So speaking into how much risk we need to take, it's, there's less of it that we have to do to obtain some of the returns we have. So I think being called specifically IG corporate bonds, those average yields are near the high end of their 15-year range, even if spreads are very, very tight, just because rates are higher and we're just getting paid more for that. If you go to page 61, especially credit, almost 10% returns for being top of the capital structure. And so again, that's another part of the reasons why we have been, underweight private equity. We just do not need to take that extra risk and illiquidity and being beneath credit and debt to obtain modestly, maybe marginally better returns. So, so yeah, 2.2% for the quarter and almost 10% for the fiscal year. So over the past 5 years, it's been 9% annualized and also outperforming the benchmark by over 200 basis points. So 12 of the 14 mandates here are outperforming their benchmarks. So it's been a very strong area for our fund. Page 65 next is real estate. Is up 4.6 for fiscal year, which is, not awesome, as you can see, absolutely, versus the other asset classes we just discussed. But against a benchmark of 1.2%, I think we all know that it's been tough out there for a few years for real estate folks, given where interest rates are. But kind of the lower risk core strategies that we have are starting to rebound. A lot of them are purpose and need based. So you're living and industrial and things like that continue to have demand. Right, and then we can go to real return next on page 66. Again, this was also a strong area, up 16% for the fiscal year. That's versus benchmark of 5%. So MLPs drove this, even though it was a negative fiscal quarter. And then some of our other mandates have been starting to be deployed, and we're starting to see some good deployment and steady gains there as well. So pleased to see that. Finally, on 72, I think it's some attribution. So this is for CERS pension. You can see the chart in the orange, bottom right. There's been value add from all the managers almost across the board, besides some of the private equity, which we have most of that as legacy. So, but in all the other areas, different managers that have really been worth the active management part of it. So they produce positive alpha, and that's why we do it. Otherwise, again, back to cheap public risk. Page 76, I think this is Steve's favorite charts. And this shows the performance against peers. The pension and insurance portfolios have all done very good top decile risk-adjusted returns over 1, 3, and 5 years. So again, that is what we're trying to do in terms of we're going to take the risk. We want to be paid for it, and I think that we hope to be able to continue doing this. All right, page 80. Let's see here. This is against all public plans here. Overall, larger public plans have kind of outperformed smaller ones. Usually they have larger illiquid allocations, especially to PE, and as we know, that's been difficult for them. So the broad universe has had a median return of 11.06%, and our portfolio is around second quartile performance in that universe. And then we have top quartile or decile performance over the 3, 5, and 10-year periods, as you can see from those numbers like 19, 6, and 18. All right. Then some other things besides Wilshire. I mean, there's different universes you can have. So the large plan universe, so any AUM over $1 billion, which is, I think, large would be bigger than that, but that was 10%, 10.1, and median for BNY all public plans was 10.65 versus the 11s that we had. Finally, we go to page 84 here. This is asset allocation compliance. So all asset classes are within the specified range. We took the opportunity to reduce our overall weight to public equity, given how strong it's been, and rebalance between U.S. and non-U.S. equities. There's still a little bit of overweight, partially to offset the underweight in other growth asset class, which is private equity. Core fixed income, we're still neutral duration. Yield curve position is pretty neutral too. Rates are range bound for now until we get a little more clarity, which who knows when that'll be. But I think obviously last Friday we got another clue. So real return, that you'll continue to see that blue triangle go to the right as we have more capital called down by managers. So I think 90 million was called and invested there for CERS during this past quarter, and we are continuing to have more of that. I think we actually our maritime, our new commitment was just the first part of it was just called. So we're continuing to look at additional investment opportunities, and we'll hope to keep adding to that. So, and that's we can go to page 98 after that. All right, this is capital calls and distribution. So Just one enhancement that has been implemented based on something that Lyle had asked for during a finance committee meeting. This is now subtotaled by asset classes. So you can see which the different portfolios cash flows. So on 98, that's the things that are in and out of the PE part for CERS, real estate, and real return, and special credit on 99. So hopefully that helps a little bit in terms of seeing where those are. All right, page 119, please. This is on to the budget. Oh, actually, I guess we'll just take questions first before we go to the budget. Does anyone have any questions about the portfolio or any of the things we've been talking about?
Thank you for your presentation.
Sure.
Any questions?
Only question.
Yep. Go ahead.
Just a brief question. You know, I know we touched on, or Wilshire touched on Plan B. I don't know that I've heard any discussion with regard to energy and utilities in particular. I'd be interested in hearing both Wilshire's and Anthony's take there going forward, given the challenges we apparently are going to be facing there, if that's an opportunity or not an opportunity.
Or could you clarify the question a little bit? What's Plan B? I might have missed something.
I think Wilshire can chime in, but I think their Plan B had specifically identified, what was it, gold, Bitcoin, and something.
Yeah. Bitcoin with the heavy caveat that it's still kind of on the fringes, I guess I'd say, of institutional adoption. Just in general, the looking at assets that might be able to provide protection due to scarcity or inflation capture in the event that we see an uptick in inflation due to the U.S. government printing its way out of the current financial or fiscal situation. So.
Sure, yeah, go ahead, and then I'll just add on from you guys.
Sure. Again, I think apologies for this being somewhat of a non-answer, but I think, like I said before, when you're asking about private credit, I think when it comes to energy and infrastructure, those types of real assets, it really depends on the manager and the strategy. There's going to be a role for traditional sources of energy to play, as there's a big push also to pursue more green types of energy. I don't think it's possible that we continue to produce enough without relying on more projects in oil and gas, but at the same time, the growing importance of green or nuclear energy, I'm sure is going to provide plenty of opportunities. So finding the right managers who have the right projects and are, in some cases, have partnered up with the firms that are driving a lot of this demand with their data centers for AI. Specific deals are going to provide more compelling options than say just going out and buying public gas companies. So I think on the private side, there's definitely going to be opportunities, and finding the right managers to capture those is going to be the key.
I read or saw something not very long ago, a few weeks ago, that had me thinking. We talked about oil, gas, green energy, all the things that you just listed off, but nobody talks about the need for just transmission upgrades. And I saw a figure of something like 100,000 miles of new transmission lines are in need per year. Is there a way or a mechanism to capitalize on that area?
I'd have to look into that and get back to you.
There was some of that in the infrastructure bill, wasn't there? Which is now being cut back by the Trump administration.
Exactly. So I just wonder if they're not going to have to turn to the private sector in order to accomplish that. Similar way that we did with the toll road in Texas, for example.
I mean, I think it's tough to find direct ways for us to do that, but I'll try and answer your question a little more directly. We have a spot, we do a private equity manager that focuses on industrials, that's middle ground, and they have tried to have some exposure to companies that have more of that. They, to varying degrees of success. I've seen a couple other, I think Oak Tree's raised a power fund that's really supposed to focus on the picks and shovels, kind of like that. Strategic Value Partners, who you guys approved today, has bought a few power plant assets that are also, have increased in value, obviously, given their importance for data centers. And that going forward, we already have exposure to with MLPs since the natural gas, the demand for that continues to increase both for export and for the data centers, since it's a reliable source of power, not intermittent. So they are a large beneficiary. If you listen to any of the earnings calls of those midstream folks, they talk about that. And in terms of scarce assets, that's why I think we've presented and you guys have approved investments in farms, sports teams, the barge leasing. I mean, I much prefer it to real estate. Rather have a bunch of vacancy. These are all no vacancy. That's what they got. You have only so many sports teams. All the farms are rented. All the barges are used. I mean, it's full on utilization. So that's why we've been trying to add exposure to that. Rail cars is a little less favorable, but still pretty good in terms of utilization and supply demand. I think most people are at this point are very disciplined. I mean, if one of the producers did decide to make a bunch of cars for whatever reason, that could disrupt the market, but you haven't seen any evidence of that. And really, I think from what I could tell from those producers, they tend to use that as kind of a cookie jar. Like, they can sell off some of their cars in the secondary market to, let's say, enhance earnings when they need to. So they have not been overly producing things to disrupt that. So that's why we've been focused on areas like that. Unfortunately, CERS, you guys did not approve the oil and gas investment we did in April, which is producing cash flows fields in the United States. But again, there's only so much acreage that has that. And so that'll either be valuable for the next buyer or they'll just continue to produce barrels and generate cash flow. So yes, those are areas that we think are important. And we're definitely looking at that. I will say we have seen some data center opportunities, of course, but a little wary of that. I think if you listen to a couple other tech people, it's not certain that we're going to need all the energy if different computing advancements occur. So we could potentially have some more exposure to that, though, through one of our core real estate funds, which is looking into some of that. I think on their closed-end side, they have done some data center investments. And then for the core side, would be more having things that are already built out and long-term leased. And so that's something that would be the kind of exposure that we would get there. And with obviously very, very high credit counterparties. But they've been looking for over a year now and have not, I think, done anything yet, but they're looking at it. And our industrial fund, they did convert one of their warehouses to a data center and sold it earlier this year, I think. So that's not like widespread in their portfolio, but again, that's a potential for something for them to do. So we are on the lookout for different things that could be opportunities and could benefit from that. But I mean, you're definitely right. The power stuff it's just like our farms, just like all the things, every electron that's out there, people are going to need it. So, yeah.
Well, the 100,000-mile figure I missed a minute ago was not new lines; it was in replacement lines.
Oh yeah, I mean we have it. I get to experience it every time I drive out my house. They're fixing all the poles, so I'm closing down a lane of the road, of Shelbyville Road. So, yeah, it's definitely needed. It's happening. So there's lots of it.
Yeah.
Any other comments, questions?
Promise I'm done, Dr. Hackworth.
Okay. Right. Anthony, anything else that you'd like to?
I think Steve we just had a couple budget things, and then Carrie had probably a few comments, and so
Great.
I'll try and make this fast. Though page 119.
Why don't you go to the budget things? Yeah.
Sure. All right, we'll just go to page 119, please, Cindy. All right, here. All right, I think those of you who are on the finance committee have seen this. Expenses have been in line for the fiscal year. We've spent about 89% of the amount budgeted. It's about $4 million or 55% higher than fiscal year, which sounds like a lot. Of course, you might guess a lot of that was from legal, and so that's what that was. Michael Boards and his team, they did a good job of budgeting for that increase. It's hard to know how litigation goes, how lumpy it is, but In this case, yeah, again, 88% of the amount budgeted for legal and audit was spent. So it's still going to be high. It's still going to be higher a little bit for this next fiscal year than it was before, but that's a decrease from this previous fiscal year. But so consulting services, about 82% of about budgeted was spent. It was all in line except the line item for new private markets consultant. So that is still on our to-do list for this next fiscal year. And then contractual services in line with budget, 101% of budget, $3.6 million. A lot of that's custody fees, so which we have to have. And let's see here. And so we have been getting more proposals for monetization from data providers. So even index vendors trying to charge for more things. So I'd expect to see costs continue to rise there, like in a lot of areas of life. All right, page 122. All right, at the pension level, investment fees and expenses were up $20 million. That's 14% compared to the prior year. That was primarily driven by performance fees, which accrued given that things did well this past year. Similarly for real estate, which is that's on here. Yes, real estate. Those fees expenses were up $7 million, and about 2/3 of that was increase in performance fees accrued. So we kind of reversed some of the negative accruals probably from previous years. PE increased $2.5 million. Again, almost $5 million increase in performance fees. Admin expenses were up by $2.7 million. Overall, that was due to legal. And fees and expenses for public equity increased by about $2 million. That was because of the appreciation of the market. So, how much percent off AUM? There's a little bit more. And finally, specialty credit was the main exception. That declined because there was some decrease in performance-based fees there. So. If there's any questions, happy to take those now.
Any questions of Anthony? If not, thank you very much for your presentation. We appreciate it. Very detailed.
Thanks. And I think Carrie has some compliance points too. No.
Well, just maybe a quick summary on the compliance. I reviewed the report. I think everything, all the issues that are typically reviewed are all in compliance. So I don't think we need to spend time going through that unless there's something you want to highlight, Carrie. I think the report's pretty straightforward, right?
Yes, nothing significant to report.
Right, thank you. Okay. Any other comments or questions? It's been a long meeting today. I appreciate your endurance and a lot of the materials covered. But any other topics, conversation points, anything else? If not, thank you to everybody for being here this afternoon. And it's been a good meeting, covered a lot of topics. And the annual review is always good, particularly when the news is good. So Anthony and Steve, congratulations, good work. And Bushra, thank you for being here. And I believe that's all for us today. And Lyle, anything else that you had bring up?
No, sir.
Okay. With that, I will consider the meeting concluded. Thank you all. Have a good week. Bye now.
Jack,